Hi, this is Marty Sakata of the Ivy Family Office Network. In this time of pandemic, we've seen a resurgence in specific hedge fund performance where superior strategies have outsized returns versus the rest of the market. I'm happy to introduce Gammon Capital for this month's podcast. Gammon Capital combines two of my favorite subjects, options trading and artificial intelligence. Michael Mescher of Gammon started out in options trading in Chicago, and after a long career as head of special situations for one large bank and sometime in the hedge fund industry, he launched his own hedge fund focused on volatility and special situations using AI to recognize those situations. Gammon is one of the top performing hedge fund strategies this year with around a 600% return on investments. Michael, please introduce yourself.
My name is Michael Mescher. I'm the CIO of Gammon Capital. We're a derivatives trading firm that specializes in the applications of AI and machine learning to the options market, in addition to special situations trading. Prior to starting Gammon Capital, I worked as a partner at Ronin Capital, which is a Chicago-based hedge fund. And previous to that, I was the head of special situations volatility trading at Barclays and Lehman Brothers prior to that. I started the fund because after trading options for about 15 years, I realized that everybody was doing everything the same way. And it occurred to me that using AI and machine learning and applying that to the volatility markets might be able to uncover some sort of trades and edge that I was able to perceive, but wasn't necessarily able to quantify. So I went out and started the fund. I acquired a tech company, and I used those guys to help me build out my IP infrastructure, and the rest is history.
We've spoken to many emerging manager programs in the past. One well-known endowment once told us they look for strategies that agree with where they see the market going. Can you tell us how your strategy behaves under different market conditions or direction?
At Gammon, we don't really opine on the direction of the market so much. Calling market direction's a pretty difficult game. Rather, what we do is we think about the distribution of the market. Typically, equities follow a relatively standard normal distribution, maybe with a little bit fatter tails. But in trading options, you have the ability to define what that distribution looks like. And to the degree that the market is not accurately reflecting that distribution of returns, we're able to go in and structure positions that can efficiently capitalize on that mispricing. So having said that, without really calling a direction in the market, one thing that we do see is an increased fattening of the tails. So what do I mean by that? Typically, those are referred to as black swans or white swans, depending on how well you know about them. But there's a number of catalysts going on, some that are apparent that everyone is aware of that could create the potential for volatility. But there's also other catalysts on the horizon that are buried deep in the legislation and the CARES Act that a lot of people don't know about. And those also have the potential to create a significant catalyst for volatility.
You said that there are more fat tail opportunities. Some are systematic, some are generic, and some more obscure. Can you discuss what type of opportunities you see in general this year?
Over the last couple of years, we've seen a lot of people pouring money into exchange-traded products, whether they're ETFs or ETNs. And as that market's maturing, we're seeing a lot of sophistication in these products. And with increased sophistication, creates different dynamics and nuance that a lot of people aren't necessarily familiar with in the ETPs. For example, there's a number of ETPs out there that have functions in them, whether it's a rolling yield or a leverage or some sort of factor like that that create decay. When you take a look at those instruments and you're able to apply machine learning and options to that space, you're able to uncover a lot of different opportunities in terms of mispriced distributions. Furthermore, we are able to take different options and different names, and we're able to structure highly efficient positions that give us great payouts in multiple scenarios, whether the market's up or down.
You talked about situations in mispricing from ETPs or ETFs. Can you discuss how you address special situations or quant situations that can be arbitraged?
So one of our biggest edges over at Gammon is in our structuring. We spend a lot of time thinking about the most efficient way to structure a position. So when we talk about addressing the different opportunities, whether they be a special sits opportunity or a quant trade opportunity, the first thing that we're doing is thinking about structuring. Which options can we pull from the universe of options that are traded to be able to create the exact type of risk profile that we want that perform specific ways in different types of markets. Once you start to understand that, you're able to build a diversified book of these different positions, and that gives you the ability to perform in all kinds of different markets. So when we talk about addressing these opportunities, a lot of our edge really comes down to structuring.
So you're a volatility and special situations fund, but your fund functions as an all-weather fund for most purposes. Please discuss how your strategy behaves in different market environments, whether it's high volatility or low volatility.
So the options market is a very dynamic marketplace to be operating in. So when we think about different types of environments, you can think about high volatility markets or low volatility markets. Since the beginning of this trade, since the beginning of our fund, actually, we've been exclusively long vol. We expect to be long vol in the future. Obviously, when you're moving from a low volatility environment to a high volatility environment, that creates the most opportunity. And that's when you're going to start to see significant returns in our book, upwards of high double, low triple digit types of returns. Now, having said that, the way that we structure the positions, we're still able to perform in those low volatility environments because we're hedging different risks with other types of risks. So for example, we might hedge our volatility risk with directional risk. So in a low vol or high vol market, we're able to structure different positions that are able to function efficiently in those specific type of market environments. So once again, it really all just kind of comes down to structuring and being able to apply our machine learning and AI to the universe of options to determine what the most efficient trade structures are for different types of market environments.
What happens when the market changes direction?
What happens when the market changes direction? So this is one place that we actually have a lot of edge over the typical equity long short type of traders. When we think about the market changing direction, typically we think about the market and it's moving up in a relatively controlled fashion. And then occasionally there's either a transient sell-off or there's a very violent sell-off. And with those violent sell-offs come increased volatility in the market. So what you have to do is you have to position yourself for all types of markets, whether it's that rallying market or whether it's the transient drawdown or whether it's that more violent drawdown. So what happens when the market changes direction? Since we're a long volatility fund, we're long gamma. And what gamma is it's basically the rate of change of directional risk. So for example, let's say that our overall portfolio is positioned relatively bullish. By purchasing a lot of different options, we're getting long gamma. By getting long gamma, our delta exposure, meaning our directional exposure, can change very rapidly. So to go back to the environment where you have a steadily rising market, we might be long directional risk so that we're able to participate in that rally. But through this long gamma dynamic that I'm talking about, as soon as the market experiences that violent sell-off, our directional risk goes from being long to being short. So as the market's sell-off becomes more violent, we actually perform better and better and better.
So we've lived through a lot of special situations in 2020. What happens in situations when there's political change or pandemics? Can you describe it?
So big catalysts like the election or coronavirus or any sort of regulatory events, those create potential big moves in the market. Those potential big moves in the market represent a higher volatility environment, and being long volatility like we are, typically those types of catalysts present significant new opportunities for us. In addition to our typical quant trading, which is really the bedrock of our program, we also lever my special situations background from Lehman and Barclays, and we're able to take a look at very esoteric situations such as the election or coronavirus and determine whether or not the distribution of equity returns that's being presented in the market is actually a reasonable distribution of returns or not. If we notice a large discrepancy there, there's a significant number of ways that we're able to position for that while simultaneously protecting our downside if we're wrong.
So you've worked in this sector for years. People are notorious for coming and going in the trading business. What makes your approach so durable?
So I've been working in the options market for probably almost 20 years now. I've got a pretty significant background in the options market. And the great thing about the options market is it offers the opportunity to get asymmetric risk reward. So what I mean by that is when you're long an option, you have the ability to make infinity upside, but the most you can lose is a predefined amount. So when you take advantage of something like that, that gives you a lot of upside volatility without necessarily having to harness that downside volatility in your P&L. So being able to lever my special situations background, my 20 years of trading options, the 10 years that my tech team has been developing out our IP, all of these present different opportunities for us to go out into the market and uncover opportunity. Also, talking about what makes a strategy durable, there's a couple different things that typical options traders do that's very different than what we do. Typically, the way that they trade and manage risk is very different than what we do. We are much more diversified in the way that we control risk, and that unlocks a significant amount of opportunity. And also in terms of options trading, one of the things that makes us more durable is we have the analytical firepower, the analytical horsepower to be able to go through and synthesize all of the data in the options market, which is many orders of magnitude greater in terms of the amount of information than you would typically see in an equity long short strategy. Being able to ingest all of that data and run with it and analyze it in the context of what we think a proper investment ought to do gives us a lot of edge, and also kind of creates a moat around the strategy just because that analytical firepower is a very, very difficult hurdle to achieve.
Do any events make your strategy more timely than others?
So being volatility traders, we're always on the lookout for potential volatile situations in the future. We don't necessarily need those to perform well, but those do present significant opportunity to move the needle very, very quickly. Now, when we think about our strategy being timely, there's a couple catalysts that are on the immediate horizon that the market's not really addressing appropriately. This is being filmed in November of 2020 for reference, just right after the elections, while the coronavirus uptick is still there and Trump is not necessarily conceding the election. So right now, there's two major catalysts we see on the immediate horizon. And by immediate, I mean the next couple months. One of them is the coronavirus. Everybody can see that. Everybody can see the uptick in the terms of cases. Everybody can also see that the deaths are starting to level off a little bit as we get this thing under control. That represents one potential catalyst. Anything with Trump represents another potential catalyst, although that seems to be tempering slightly. But another very serious catalyst that's on the horizon is if you go back into the legislation from the CARES Act, the original stimulus payment, in those documents, there are certain passages that allow entire sections of industry to throw out GAAP, generally accepted accounting principles. Basically, any debt that they have that's been impaired by COVID is allowed to be carried as fully performing debt on the books. Now, this cooking of the books, if you will, has a drop dead date. And while another round of stimulus may push that drop dead date out into the future, and everybody can continue to pretend that everything is fine with the economy, there's also a significant chance that this isn't going to get resolved with stimulus before that drop dead date occurs. If we cannot address this problem through additional stimulus before that drop dead date, everybody's going to start to see that the economy is nowhere near as comfortable as they think it is right now. And that represents a potential very significant downside catalyst. So in terms of positioning for volatility and potential events in the future that would create volatility, this is pretty timely on this one.
Leverage plays a role in most strategies. Do you use leverage? How do you use it?
So when you're trading options, options have inherent leverage. And that's actually a great thing depending on what side of the trade you're on. There's a lot of people out there who have